Good day, fellow investors. We continue with our portfolio reviews, and a very interesting portfolio is what we have here. 6 positions, 27 million. And if you look a little bit at things, the most recent gain on the current position is about 6 million. The earlier gains were made on one position earlier. That worked well. And if we look at the annualized return over the last 3 years is 55%. The gain 13 something million, so all great. Of course, the portfolio was started in December of 2022, so really before a bull market, but that was a prescient call. This is Alan's portfolio. He said he got lucky here and there, got Nvidia and Google after Liberation Day, good returns on one tech stock earlier. Nevertheless, now going more for a barbell strategy with still some growth. He says he would not buy Nvidia now, however, adding value components for long-term, let's say, compounding. Let's see how that works. And the best way perhaps to focus on this is to just check stock by stock, as the weights are significant and therefore have an impact on such a portfolio. So let's go. He says few high value stocks. Let's see how high value that is, how risky is the other, and of course I'm keeping all the names confidential when I do these things. Let's start immediately with Google, reaching 300, Buffett bought, and of course it is double of an investment since Liberation Day. I've recently also enjoyed Brandon's video on why Warren Buffett bought, how can that fit his mode perspective. However, we also discussed Google a few times on this channel, also how it can boom on the AI bubble, and everybody said I'm crazy to saying that it can go to 500. We are already at 300. Then, of course, we discussed the risk there, Google, ChatGPT. I still think there is a risk there, but it was the best buy of the Magnificent Seven, just on low valuation. Same that we discussed constantly on Google when it was 136 just a year ago. Why didn't I buy? Well, I think I have a fixed mindset. I like what I own. Perhaps I just like it now and liked it back then more than Google, and fix my, I don't know, maybe my mistake, but that's always easy to say in hindsight now that Google is a double. But what I do works for me, I'm happy with that. And by the way, you can check my research platform if you want to add a true value investing pillar to your, let's say, portfolio and long-term wealth compounding. Now is a great time to check, because value, as everything else, is in a bubble. Value now is at a discount. Continuing on Google, Buffett usually sells most of his stocks, so he might have started a position or somebody at Berkshire, and then they will see. However, back then, perhaps they bought it all in earlier, depending on how they disclose it. Back then, it was value, low P ratio, below 20, so it might fit, okay, let's put some money there as a perspective of the Berkshire cash empire. And if they bought here, they already made their money, so it's not 50 billion spent, it's just 5, perhaps they wanted to accumulate more. But if you look at earnings, everything looks great, 35% earnings growth, 60% revenues growth, everything still looks great with Alphabet, except also, as everyone else, they are pounding on those capital expenditures to try to win that, let's say, AI competition race. They're doing well, but the cash flows are 73 trillion, declining a little bit compared to the increase in net cash provided by operating activities. And if I look at these things, 73 billion comparing to the market cap of 3.6 trillion, that is a 2% free cash flow yield. A 2% free cash flow yield, yes, Google is expected to keep on growing and everything looks good now. But that's also, there is always this worry that I have, how will it look 2 years from now? That's my key concern, and perhaps the reason why I didn't invest in Google, even if And this is everyone's focus, the short term, the few quarters, even if it was very likely that the current quarters and perhaps the next few quarters will still look great. For me, now, especially now, it's too risky. It's not 17 or 20 the P ratio, it's 30. But then again, I haven't done 55% per year over the last few years. Is there more room to grow? Definitely. On AI, on good earnings, if that growth rate keeps on going higher, stock will follow. However, from a portfolio management perspective, Charlie Munger would say, you don't need the last dollar. Therefore, if you made your money on Google, now is the time to be more conservative, because as the stock price goes up, so does the risk, and the return mathematically goes down. So I would put Google as medium reward, medium to high risk, somewhere here on our quadrant. Next position, Petrobras, Brazilian oil company. What is this? 18.5% of the portfolio, going for something considered value, a good 10-11% dividend yield on, let's say, a big global oil company. I did an analysis the beginning of the year how, yes, it is a buy on that dividend and on that risk and reward. However, if we look a little bit at the free Q performance, everything looks good. Good free cash flows for the company, good operating cash flows, everything is growing. Consistent growth in production, all good, and they have a lot of debt, but they are able to borrow at lowest spreads over sovereign bonds and lower spread over treasuries since 2001 and since 2011. For a Brazilian government-owned oil company, okay, that's a risk there because their debt is going up, they're paying a great dividend, no worries. However, when you are so levered, any changes in that and distribution of returns, half of the free cash flow is going for dividends, so expect a 10%, 11% yield at current prices from current cash flows. The risk. If we look at Petrobras, it's highly sensitive to oil price fluctuations. So Google AI and investing is working, but there are no clicks, there are no ads here. So we'll see how that works. But if oil goes to 50, the dividend will be significantly cut without going to more debt. So that's the key risk. And oil has been declining over the last few years. Of course, if it goes to 80, Petrobras will do a lot of money, and you can expect a 2x in the stock price. I think that Petrobras should survive. However, when I look at the high debt, oil at 50, dividend pretty much gone, there could be a risk of a 50% stock price drop. That is why you have that 10% yield, which makes it risky, which makes it not a true value investment. Okay, there is upside on oil prices going up, on a boom in oil market. Unlikely, because all oil players are just going for growth, wherever I look at whatever scenario. However, if we look at the real long-term demand going forward, it's stagnant, but production, as they were flushed with cash flows over the last few years, is going higher, and all you need a recession to, let's say, create troubles there. Therefore, I have put here Petrobras on our quadrant like a 10% yield, okay, but high risk. And especially now, all players seems to be expensive. It's better than the major oil players from the developed world with 3% yields, which is crazy risky. But when it comes to oil plays, I miss the certainty. Medium risk, medium reward. That risk means 50% down for Petrobras. Yes, the government might intervene, but you never know what will happen when the environment turns ugly. And with oil businesses, every 5 to 7, 10 years, the environment does turn ugly, and that's the time to buy. Not now when things look too good. Global ship lease shipping companies. Now you'll see me rarely discussing shipping companies because there is a simple business model when it comes to shippings. And that is, like, you have to think the Greek guy just finished with his oil harvest somewhere in Greece, concerned that his kids might not be as conservative as he is. What do these Greek guys do, and in general shipping owners? When the situation is bad, when the price to book of the ships is 0.2, so 20% on the dollar value of the ships, they buy back their own shares. They issue shares, they invest the money. When the things are going great, they pay a great dividend that they put on their account, put it in treasuries, and then wait for the bad cycle when they will again issue shares to repurchase. I, as a retail investor, cannot do that because when are those private placements and things like that, I will not be allowed to do that. So I can buy here or perhaps here when they are adding, but if they are not issuing shares, I'm not interested. This is the time to buy ship stocks, not this. So, high risk situation, even if everything looks great, look at the earnings per share. What's that? A P ratio of 1 if the quarter gets through the year. Everything looks great. They have contracted revenues for the next year and a half too. They have been de-risking the balance sheet, all good. Reduced financial leverage because the EBITDA is high. When the EBITDA goes low, you can quickly get to higher financial leverage. Everything looks good. The borrowing costs now are ridiculous. You will see it at 15% when things look ugly, when they will issue shares. Order book, many new ships. Everyone is focused on the big ones, not on the smaller ones, but okay. If you look at the shareholders' equity, 1.7 billion, you're still buying all those ships at a discount to net present value, and the contracts are there, everything looks great for the next year, year and a half. But that's what we know now. If the environment changes, global recession, slowdown, whatever, everything changes, the value of the ships go down, impairments, things like that, refinancing gets ugly, everything gets ugly, you need new capital, they issue shares at low prices. And this is the environment you want to invest in or think about surviving. That's the time to look at ship stocks, not when they are making huge money. And you can see here equity issuances when they can. High risk for a 7% yield. United Health, I don't know much about health. I know it looks great, the numbers look great. Now they have had this hiccup and okay, profits are slightly growing again, revenue is growing again. I would say it's fairly valued. I'm not going into health companies like pharma, things like that. Not my circle of competence. So I'll skip this one and I'll say maybe it's fairly valued. Next one, Nvidia, and the owner said he would not buy Nvidia anymore. Now, okay, it has really boomed since he bought, great return there. P ratio 50, but given Nvidia's growth and the coming spending that everyone has announced, buying more Nvidia chips, the P ratio might be 20 2 years down the road, and therefore it's not that expensive from a valuation perspective. Because if we are not in a bubble and no incentive related, Jen Sun Huang says we are not in a bubble, so okay, but let's put a little bit of numbers here. When you invest here, you want to get your money back. So let's say that in 5 years, for a good return, this has to be an 8.6 trillion company. So you want a 2x, because investing is about getting your money back and more. How will Nvidia look like in 5 years is the key concern I have. Because in 5 years they would need to double again, 5 to 7% growth, and to be at 8 trillion in 5 years, let's say I need a 5% yield from Nvidia, 8 trillion, 9 trillion, that's 450 billion of profits, free cash flows that it can deliver to shareholders, which means the growth should be to 1 trillion in sales and then 400 billion in free cash flows. 1 trillion in sales would be double the current semiconductor market size, of which Nvidia has 16%. So when the current mania stops, I hope that the worst what it can happen is that Nvidia in 5 years goes up and then goes back to 4 trillion. However, there is the semi-cycle. If the investments don't look profitable as they are expected, the new tech is coming, things like that, too risky for me. But the owner made his money already, there. Then we have Archer Daniel Midland. We'll discuss that in a private video. I have made a great deep analysis on ADM, the long-term risk and reward, so you can check that video in the link in the description below. And when I made that video, the stock was a little bit cheaper. I think the returns here are good, but there has been some volatility. But now the dividend yield is at 3.48%, so not 4.5% anymore. I would say now it is fairly priced. And it is here on my quadrant, so medium risk for a 6% return. I would like it more when it is here at a 10% return, but okay, this is true value, we will need food, so this is the component that I think that over 10 years will deliver a return for this portfolio for sure. That's 1 out of the 6. So what is my opinion here? Mid-risk, mid-reward for ADM, the rest is too risky for sustained compounding returns over a lifetime. And yes, the owner here made his returns by investing in stocks that go up. However, is that a sustainable strategy? And a lot of even the value positioning there looks like, okay, this is now cheap, has to go up, and that's the strategy. But that's not absolute fundamental investing, because if I look at absolute fundamental investing, maybe over cycles, if things go good, we are at around 4 or 5% for this portfolio, which compared to the 55% return per year over the last 3 years, might not be the strategy, especially given the risk. A recession would clobber this, and then you can lose, if there is a big hit to markets, a recession, you can lose all the gains made in the last 3 years, which means this portfolio can be down more than 50% in an ugly situation. And you can see here, Berkshire cash pile, 382 billion, and there is a reason for that. Because, okay, you can accept volatility, whatever happens, I'm okay, it will return, but that's not what worked to create this value. So I would think of hedges, and perhaps more true real value components in that barbell. Then also, as I said, Warren Buffett is in cash. This portfolio was made by really taking advantage of cheap situations, Nvidia, Google's, other tech stocks. So why not, instead of buying riskier things to stay invested, shift to cash, wait for other opportunities, as were those when you had your money. You still get 3-4% on the short-term treasury, and you can wait for better. That's what I think. Why changing a strategy that works? Simply wait for where you have the insights. Also, hedges, options, perhaps too much work. Maybe something on my research platform could be applied to a true value investing pillar that might also work as a hedge there. So, I hope you enjoyed this review. Check my other reviews in the playlist in the link in the description below. I'll see you in the next video.